Hello, everybody. I am Johanna Chesbu, and I'm the Director of Vendor Management here at CAMS. Today, we have Eric Bregman with Earney Accountants and Advisors here to talk to us about part 2 of our Homeowner Association Accounting and Commonly Asked Questions. Hey, Eric, how's it going?
Good. How are you?
I'm doing well, thanks.
Good. So my name's Eric Bregman. I am a audit partner at Earney Accountants and Advisors. I lead our audit practice as well as I am the practice leader on all of our homeowner association audits, reviews, compilations, as well as tax returns. We do over 200 of those. In this part of the presentation, I'll be touching on a little bit of tax commonly asked questions, and I'm going to go through some specialized footnote disclosures related to homeowner association financial statements.
That sounds great. Let's dig in.
So we're going to switch gears really quick, and we're going to briefly talk about some tax-related items. I'm going to keep this very brief, and just to kind of put out there and answer the question of the most common question that we get related to taxes is, I thought we were tax exempt. I thought we were a nonprofit. Why do we have to pay taxes? The general gist of this is that, yes, you are organized as a nonprofit under state law, but you are not tax exempt under IRS rules. And you are not treated as a nonprofit according to generally accepted accounting principles. You're treated as a hybrid, for-profit governmental hybrid entity for GAAP purposes. But the key here is that you do have to pay taxes. Generally speaking, the most taxable item that most associations have is interest income.
Yep.
It is considered a non-exempt function, and so the interest income is the thing you're most likely going to pay tax on. There's other things, rental income, easements,
Amenities.
and things like that, rental income. But interest income is the biggest thing. And we get the question all the time, like, well, I thought we were tax exempt. I thought we were a nonprofit. Well, yeah, you are a nonprofit, but you're not tax exempt.
Yep. So you still have to file those taxes every year.
Yeah, still have to file them every year. And it's super important now, especially with interest rates being 4.5%, 5.5% on your CDs, that you're likely going to get more interest, but you still have to pay tax on that. I mean, we can remember from a short 2-3 years ago when you're getting 0 point nothing on a CD, and it wasn't a big deal. But now that kind of is, and there's more associations that are paying tax more now than ever. So
that's a great point to make.
Yeah.
All right.
So I'm going to skip to the next slide. And I'd mentioned before about some of the items in an association's financial statement that are of importance. So the first thing we'll talk about is fund accounting. You have your operating fund, your capital reserve fund, and then sometimes a non-capital reserve fund. And those funds obviously go from least restricted to most restricted. But a typical HOA financial statement will have two or three of these funds, and some associations have a special assessment fund, some have an amenity fund. There's a number of different funds, but it's all presented on a fund level. Reserves. I could probably talk for an hour just on reserves, but I'm not going to spare everybody. Reserve disclosures. So there is a required disclosure that all HOA financial statements are required to have, supplemental schedule. We are not allowed to opine on it. We have to disclaim on that information, but it is included in the financial statements and it is required, and that lays out the reserve study, the estimated repair replacements for the next 20-30 years, and then and then you can relate that to the cash and short-term liquid assets you have set aside for those reserves.
Okay.
And it's important to note that reserves are just mini savings accounts. A lot of times people don't have an understanding of the fact that reserves are meant to be spent. They are there to be spent on future repairs and replacements. And you are just part of your assessments, hopefully every month, are going into your reserves for the board to make sure that the amenities in your common property is in good standing and is up to date and in good working order. So that's kind of the point of reserves.
Which is also something that banks look at for making sure that the the common areas and, as you had mentioned, amenities, they're all in good shape, and that the board is proactive in taking control of that with their fiduciary responsibility, and actually following suit with the reserve study and the components dictated on a year-to-year basis.
Yeah. And I'm happy to, if anyone has questions at any point in time, they can reach out to me, and I'm happy to let them know, hey, what is a reserve expense and what is not? What can you use it for? I'll just say for the record, painting, not a reserve expense.
Yep. It's a regular wear and tear type of maintenance item.
Yep. But if you're replacing your HVAC, that's a reserve expense.
Okay.
So, and then couple other items, prepaid assessments, you'll see on your balance sheet. That's when you pay your assessments in December for next year. They'll show on the balance sheet as a liability until the year in which they're earned. And then property and equipment. This is another common question that we get sometimes, is for people coming into the association world that have some sort of accounting background and they don't see any property and equipment on their balance sheet. You're not going to have it typically, because common property is not capitalized. It is expensed, just like the reserve expenses to maintain it are expensed. Personal property is capitalized. The personal property, the best example I could give of that is if a large association owns a vehicle that the association itself owns.
Maintenance vehicles.
Correct. Okay. Yep. That would be considered personal property, and that should be capitalized and depreciated.
Okay.
And as I mentioned before, a lot of times people look at depreciation as a tax benefit. As I mentioned before, this stuff is exempt. It doesn't matter how much you depreciate it or how fast, so there's no real extra benefit of having it on the balance sheet, but that's kind of how that works.
Okay.
And then I mentioned those reserve disclosures, and the last thing I'll note from a disclosure perspective is the insurance disclosures. We typically like to include a footnote that lays out how much wind, property, flood insurance that associations have, just so a homeowner can look and it's like, oh, okay, our common property is properly insured.
Okay.
It's a super important and valuable piece of information that homeowners and banks like to be able to see.
Yes. Without a doubt.
Yeah. So that's all I had. I have my contact information there. Anyone is free to reach out to me. I am available for questions at any point in time. From a pricing perspective, we have some information on that. Should anyone want some information, I'm happy to send that. It's pretty straightforward, pretty standard, but your larger associations, typically things tend to be a little harder from a pricing perspective, just because they have a lot going on, but
a lot of variables that go into it.
Yeah, a lot of variables, but I'm happy to have that conversation, with anybody that wants.
Do some customized pricing based on the size of the association, what they're looking for. Yeah, exactly. That makes sense. Okay.
Exactly. Yeah, 100%.
Well, thank you so much, Eric. We really appreciate the time that you took to talk with us today, to be our expert in our Trusted Service Provider Expert Series. We've got your information here, and we'll be sure to include it in the video notes as well, and every way to get in touch with you, to ask you questions, and how our associations can benefit by our partnership with you and ultimately Earney Accountants and Advisors.
Yes, thank you. We appreciate the time, and appreciate the partnership, and appreciate the opportunity to speak to you guys today.
That sounds good. Well, thank you, and have a great rest of your day.